Welcome to Talk Tickers. Okay, let's dive right in. We're tackling the latest earnings call from DocuSign, specifically your first quarter of fiscal year 2026.
That's right. We've got the materials, the transcript, the prepared remarks, the Q&A.
And the big question leaping out is this. DocuSign beat on revenue and profit, which looks good.
Mm-hmm.
But their billings came in a little light compared to their own guidance. So is that a real warning sign, or is there more to the story?
Yeah, that's the core puzzle, isn't it? Our mission here is to really unpack what management said, cut through the noise, and figure out what their discussions signaled about the business health and where it's headed.
Exactly. Looking beyond just the headline numbers.
Right. Because the context they gave, especially around that billings number, is pretty crucial.
Okay, so let's start with those Q1 headlines, fiscal 26.
Mm-hmm.
How did the numbers actually shape up?
Well, like you said, financially, it was actually strong. Better than they'd expected, they said. Revenue hit $764 million, which is up 8% year over year. And their core subscription revenue, that was $746 million, also up 8%.
So solid growth there. What about profits?
Profitability looked better, too. Their non-GAAP operating margin came in at 29.5%. That's a full percentage point higher than the same quarter last year. Gross margin also ticked up slightly.
All right, so beat on revenue, beat on profit. Sounds pretty positive overall.
It does.
But then you hit that billings number. Came in at $740 million, only up 4% year over year, and slightly below their guidance range.
Exactly. And that was clearly the main point they needed to address on the call. They spent quite a bit of time on it.
So what was the explanation?
The core argument was that this slight miss was really about the timing of customer renewals, specifically early renewals.
Timing, okay, not underlying weakness.
That's what they argued, yeah. They said this timing issue was a direct result, though it happened earlier than they anticipated, of some pretty foundational changes they made to their sales strategy, their go-to-market plan, or GTM.
Ah, right. They tweaked the sales incentives and territories at the start of Q1.
Precisely. The goal was to shift focus towards, higher value deals and selling their newer platform, Intelligent Agreement Management, or IM.
And the side effect was reps were less focused on chasing those early renewals that maybe would have landed in Q1 otherwise, and that shift just happened faster than forecast.
That's exactly it. They expected that reduced volume of early non-expansion renewals to hit later in the year, but it popped up in Q1. Management was really clear, though.
Yeah.
In their view, this was just about timing and the incentive shift, not a reflection of customer demand weakening or the business fundamentally being less healthy.
Did they quantify that at all?
They did. They said if you adjust for that negative impact from fewer early renewals than expected, plus a small positive FX effect, billings would have actually finished near the high end of their guidance.
Okay, so the narrative is, we changed the sales playbook. It worked almost too well initially in shifting focus, and the timing impact of that masked the underlying performance relative to our Q1 forecast.
Right. And they did own up to not fully forecasting how quickly that shift would impact those early renewals in Q1.
But they still think the GTM changes are the right long-term move.
Yes, they were quite direct about that. Building a stronger, more durable growth engine, even with this short-term timing wrinkle.
Okay, this is where it gets really interesting then. Because while they're managing this billings timing story, they're also talking up a lot of momentum around that new Intelligent Agreement Management platform, IM. That seems to be the future growth engine.
Oh, absolutely. That's the core of the strategy now. They're positioning IM as their fastest growing offering ever.
Really? What kind of numbers are they seeing?
Well, they've already crossed 10,000 customers who've bought some component of IM, and that's in less than a year since launch.
Wow, okay.
Customers are apparently processing tens of millions of agreements using it, and they highlighted increasing engagement, especially with the AI features, things like AI dashboards and search in DocuSign Navigator.
Right. So just to clarify for you listening, DocuSign started with e-signatures, obviously. But this IM platform is much bigger. It's about managing the whole agreement lifecycle.
Exactly. From drafting and collaborating, negotiating, all the way through to tracking what happens after the signature. Obligations, insights, the whole 9 yards.
Yeah.
It's a much broader play.
A whole new category, really.
That's how they're framing it. And they're adding a lot to it. At their recent Momentum conference, they showed off a whole suite of new AI-powered features.
Yeah, I saw that list. Things like Agreement Desk for workflows, AI-assisted review, workspaces for collaboration.
Clear for identity verification, custom extractions using AI, obligation management dashboards. Yeah, a lot of new stuff.
When is this rolling out?
They said many will be available soon. Some, like AI-assisted review and workspaces, are actually already out. They're targeting the majority to be available by August.
And all powered by their own AI.
Yeah, DocuSign Irius, their AI engine built on, their massive data set of agreements. They even teased AI contract agents coming later this fiscal year to automate workflows even more.
So a huge push on innovation centered around AI and this IM category. And it sounds like it's starting to get traction.
It really seems to be. They said IM sales beat their internal targets again in Q1. The volume of IM deals from the direct sales team was actually higher than Q4.
Which is interesting, given Q1 can sometimes be seasonally slower.
Right. And the percentage of new customers choosing IM also jumped significantly. Internationally, too, where they've been building out their sales motion, IM deals were up over 50% quarter over quarter.
That international growth is notable. What about smaller customers?
Good point. They launched self-serve IM back in April, so smaller businesses can just sign up online.
And how's that going?
Really well, apparently. They added nearly 1,000 new self-serve IM customers in just the first 3 weeks. And that was before any big marketing push, just organic adoption.
That's a strong signal. Rapid, unprompted adoption like that suggests good product market fit.
It does, and they have some pretty ambitious targets. They expect IM customers to contribute a low double-digit percentage of their total subscription revenue by the end of this fiscal year, Q4.
Okay, so lots of excitement around IM. But let's circle back. How are the fundamentals of the bread and butter e-signature business holding up while they build this new platform? Is the foundation stable?
Yeah, that's obviously key. And management said the fundamentals in the overall core business did keep improving in Q1.
Like what specifically?
Well, dollar net retention, that metric showing if existing customers are spending more or less over time, it ticked up slightly year over year. Crucially, it moved back above 100%.
Good. To 101%.
Yep, 101%. Consistent with Q4, but the key is it's back above that 100% mark after dipping below previously. Gross retention also improved year over year.
Getting dollar net retention sustainably above 100 is definitely positive. It means, on average, expansion is outweighing churn or contraction. What about actual usage? Are people using the platform more?
Seems so. Customer consumption and utilization, basically. How much stuff people are actually doing on the platform, sending envelopes, using contracts that continue to grow steadily.
Any specifics?
They specifically mentioned contract utilization in their direct business hit the highest level since early fiscal 2022.
Wow, a multi-year high.
Yeah, driven mostly by North America. And they saw a year-over-year improvement in consumption rates across almost every customer size and industry vertical for the first time in over 2 years.
That sounds pretty healthy. Higher usage usually means stickier customers,
Yeah.
right? And more potential for expansion down the line.
Exactly. It suggests the core value prop is still strong. Total customer count also grew, up 10% year over year, past 1.7 million now. And the number of big customers, those spending over $300 Ks a year, that increased 6% year over year.
Okay, so core business trends look pretty solid, maybe even improving. Provides a stable base while they ramp up IM.
That seems to be the picture they painted.
All right, let's talk guidance. What are they expecting for the next quarter, Q2, and the rest of fiscal year 26?
Okay, for Q2, they guided revenue between $777 million and $781 million. So at the midpoint, that's about 6% year-over-year growth.
And for the full year?
Full fiscal year 26, the range is $3.151 billion to $3.163 billion for revenue. Also around 6% growth at the midpoint.
Okay, and what about that all-important billings guidance?
Right. For Q2, billings guidance is $757 million to $767 million, about 5% growth year over year at the midpoint.
And a full year.
Full year billings guidance is $3.285 billion to $3.339 billion. That midpoint implies around 6.5% year over year growth for the full 12 months.
How does that compare to the initial full year guidance they gave back in March after Q4?
Interesting comparison. The full year revenue guidance midpoint actually went up by $22 million.
Right.
Reflects the Q1 beat and maybe a slightly better FX outlook.
Okay, revenue up, but billings.
The full year billings guidance midpoint came down slightly by about $15 million.
Okay. And is that tied back to the early renewal timing thing we talked about from Q1?
Partially, yes. That seems to be the main driver. Management said the updated full year billings guidance reflects more caution around the timing and potential range of those early renewal impacts from the GTM changes throughout the year.
So they're basically building in more uncertainty about when those early renewals might land.
Exactly. And they also mentioned building in some broader conservatism on just general bookings, citing the uncertain macro environment. though they did note they didn't really see a big macro impact in Q1.
So a bit more caution on timing due to the GTM transition, plus a general macro buffer, even if the macro wasn't a big Q1 issue.
Correct. Taking a prudent approach for the rest of the year, giving themselves more wiggle room on forecasting, especially with the variability around when those early renewals hit.
But they stressed, this doesn't really hurt the revenue forecast much.
Right, because it's about when the contract renews and gets billed, not if the customer renews the underlying revenue stream. The timing affects billings more directly than recognized revenue in the short term.
Okay. But despite this slightly more cautious billings guidance overall, are they still projecting growth to pick up?
Yes, they were explicit about that. They said when you adjust for the timing noise from early renewals and FX, they still forecast year-over-year billings acceleration in fiscal 26.
Acceleration when?
Specifically, they expect year-over-year billings growth to increase in the second half of this fiscal year compared to the first half.
Driven by?
Driven by the continued ramp-up and growing contribution from IM deals. That's the key driver they're pointing to for that second half acceleration.
That makes sense.
Yeah.
The whole strategy hinges on IM scaling up. What about profitability guidance? Margins?
For Q2, non-GAAP operating margin is expected between 26.5% and 27.5%. For the full year, it's guided between 27.8% and 28.8%.
And how does that full year margin guidance compare to before?
Notably, it's unchanged from their previous outlook.
So they're holding the line on full year margins, despite maybe some moving parts. What's influencing that?
Yeah, they reiterated they still expect some temporary headwinds impacting margins this year, about a 1 percentage point headwind to gross margins, and roughly 1.5 points to operating margins.
Why is that?
It's mainly due to ongoing investments, things like migrating to the cloud, building out data centers, necessary stuff for scaling and supporting platforms like IM.
Right, infrastructure costs.
Exactly.
Yeah.
Also, a shift from some equity comp to higher cash comp for certain roles, and just tougher comparisons to last year, which had some one-off benefits. The cloud migration costs were actually a bit lower than expected in Q1 due to timing.
Oh, okay.
But they expect a bigger impact in the coming quarters of this fiscal year before those costs start to ease off next year in FY27.
So basically they're investing heavily, especially in R&D and infrastructure to support IM growth, like integrating the election acquisition they made and managing other costs tightly enough to keep full year margins roughly flat year over year, even with those investment headwinds.
That's pretty much the story on margins. And they also pointed out they're still generating strong free cash flow, about a 30% free cash flow margin in Q1. They expect the full year free cash flow margin to track pretty closely to their non-GAAP operating margin.
And what are they doing with that cash? Still buying back stock.
Yep. Big time. They bought back $183 million worth of stock just in Q1. Over the last 12 months, it's over $700 million in buybacks.
Wow.
And they just announced a new $1 billion share buyback authorization. So they have plenty of firepower to keep doing that opportunistically. They also mentioned stock comp expense as a percentage of revenue is trending down over a 2-year view.
Okay, so let's try to sum up the numbers then. Q1, revenue and profit beat expectations, look strong. Billings were a bit light versus guidance.
Right.
Management pins that billings softness mainly on the timing of early renewals shifting due to strategic sales changes happening sooner than forecasted. Not a demand problem, they argue.
That was the core message.
Guidance for the rest of the year reflects that Q1 strength in revenue, but bakes in more caution around the timing of billings, especially those early renewals, and adds a macro buffer. But importantly, they still expect billings growth to accelerate in the second half, driven by IM.
Exactly. And margins are being managed through a period of investment while cash flow remains strong and they're returning a lot of it via buybacks.
The emphasis was definitely on. Look past the Q1 billings timing noise, focus on the IM momentum and the second half acceleration story.
That's the strategic narrative they pushed hard.
All right, before we wrap this deep dive, it's time for our This Is Not Financial Advice segment.
Indeed. And let me just say again, this is purely for entertainment, folks. Illustrative purposes only. Don't base any real trades on this. We're just riffing on the themes.
Absolutely. So given the whole story management laid out billings miss is just timing, GTM changes are pushing the high growth IM platform, acceleration coming in H2. Here's an idea.
Okay, let's hear it.
Go long DocuSign. Now, the outrageous part of this idea is you have to assume management is 100% right about the timing explanation. You have to assume the macro doesn't get significantly worse. And you have to believe the IM platform adoption really takes off, maybe even faster than their current guidance implies.
So betting on perfect execution and a benign environment.
Right. But the plausible angle is maybe those improving core metrics, the consumption hitting multi-year highs, dollar net retention back over 100%, the strong early self-serve IM adoption, maybe those are genuinely strong leading indicators. Maybe the market is currently too focused on the Q1 billings timing issue and underappreciating the potential speed of the IM ramp-up.
That's definitely leaning into the bull case based purely on management's narrative and the positive underlying trends. It's a bet that the IM strategy execution really pays off, overcoming the transition noise and any macro bumps. Big ifs there.
Huge ifs. Definitely do your own research. This is not advice.
Okay, so let's bring this deep dive to a close. Here, recap. DocuSign delivered a Q1 that beat on revenue and profit, showing good operational control.
Yep.
Billings growth, though, was slightly below their guide. Management put that down primarily to the timing of early renewals, an effect of the strategic go-to-market changes kicking in sooner than planned.
They were adamant it wasn't a demand issue, more of a forecasting wrinkle related to the sales transition, masking stronger underlying performance against their plan.
Right. They highlighted significant momentum and continued innovation with their big strategic bet. The Intelligent Agreement Management platform. Early adoption numbers look strong across different customer types.
And importantly, the core business fundamentals seem to be improving. Dollar net retention back over 100%, customer usage hitting multi-year highs. That base looks healthier.
Guidance for the full year reflects the Q1 strength, but adds conservatism around bookings timing and the macro outlook. Still, they forecast billings growth to accelerate in the second half of the year, fueled by that IM ramp.
And the company has a strong balance sheet, throws off significant free cash flow, and keeps buying back a lot of stock.
So our goal with this deep dive was really to give you that shortcut, to distill the crucial points from the earnings call and management's perspective.
Helping you cut through the numbers to the core narrative.
And one last time. This summary and discussion is based on the information from the earnings call. It is absolutely not financial advice. Any investment decisions need to be based on your own research and talking to a qualified financial advisor.
Okay, finally, here's that provocative thought for you to chew on. DocuSign is betting big. They're betting that this AI-powered intelligent agreement management platform won't just boost their own growth, but will actually transform how all businesses handle agreements. The question for you is, looking at the early signs in their ambitious roadmap, how quickly could this new IM category reshape the whole landscape? And where will DocuSign stand if or when it does? It's a long game they're playing, but the pieces are moving now.